Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over Twitter, see what's going on with Twitter. I'll interject my financial opinions in there. If you guys need any help with anything, definitely check out finding-value.com, become a platinum member. We talk a lot about commodities and different sectors based off of the ratios and which ones look favorable versus other ones that may be coming out of favor. We were in energy services pretty heavily in 2022, and now we've kind of shifted our efforts towards precious metals. Just an FYI. All right, so let's dive in here. Let's see what's going on with the market. So we've got, if you want to follow me, it's at finding_finance. And if you want to check me out, it's finding-value.com. So Peter Schiff says ChatGPT AI is pretty intelligent after all. It didn't recommend any allocation to Bitcoin. It says ChatGPT recommends massive allocations in gold. In its, it probably says in its recession-proof portfolio. I've seen this before. I saw it's an all-weather portfolio. They recommend something on the lines of 20 to 30% in precious metals. And I also think that it's probably a good spot to be looking at today because we've got a credit cycle that's ending, and an over-allocation to precious metals, I think, is actually a safer bet. But again, that's all opinions there. Please don't take it as advice. And that is something that I do myself, is I over-allocate to the metals compared to most other individuals. It says, why would the weather present a natural gas buying opportunity for investors? We explain why in our latest blog post. Basically, the warm weather over in Europe created a huge opportunity, in their opinion, in natural gas. We've got natural gas on a ratio basis. The cheapest asset at this time is natural gas priced against all other assets. It's even cheap priced against platinum. So natural gas is the cheapest asset out there. And if you're patient and you're willing to kind of ride through volatility, I think where we're at and where we're going to be over the next 6 months could be very good entry points for natural gas. I will be entering natural gas with some size at some point here in the future. When that ratio turns, natural gas firms up, which it's starting to do, and I'm gonna add into my favorite companies. Now here's Kevin. He says, plug pulled on national debt clock. I remember this well back in 2000. The thinking was then that budget surpluses would be paying off the debt, so it was the time to turn it off. Plug pulled on national debt clock. Here's Cuppy. It says, the president remains focused on sending oil to $500 a barrel. I thought that was kind of funny, but it is actually, I think, probably true. We're not going to go straight there. I think that we're going to dip down before we launch. And what's going to happen is we'll probably get a dip in the next 6 months or something like that. We'll dip lower. It'll scare everyone out of it. And then they're going to print money, or they're going to do something with liquidity, and then it's going to launch it to the upside. Gold and silver will be the first to react, just like it did in the 2020s, 2019, 2020. Right now, I think we're at the same spot as 2018, late 2018, early 2020, or early 2019. Late 18, early 19 is the position we're in right now. And there's a slowdown in interest rates. The interest rates will get pulled down because people will be afraid of something. Something will happen, and then we'll get a drawdown in oil, and then it'll launch like we've never seen before when they reliquefy the system, which they're already somewhat doing already. They've already printed $380 billion. This is looking for buy-in. Insider purchases for mid-cap oil and gas reached one of the highest levels in March at 11 million. These spikes generally mark good entry points for energy investors when looking back at history. The attached insider report looks at further themes, including buying from the technical officers, companies with across the board buying, and which names are trading at the largest discount to where insiders have bought recently. But here's 11 million. This is the Canadian mid-cap E&P total insider buying per month. And you can see that they're really loading in here. They also did that in June of 2022. They did it in November of 2021. Those are other large buying areas. So that is interesting there. Now I want to go over this thread. This is Kevin. I like his rant. I like it. He says, chatting with a friend this afternoon about long-term macro and gold. Got me all fired up because we are at a period in time similar to 1970. Since then, 50 years, the gold price has gone up 57 times. And the next 50 years, we'll see the same move, possibly much more. Yes, I'm saying gold will run to over $100,000 in the next 50 years, with the biggest percentage moves occurring in this next 10 years, where I see 10K as a minimum and 15 to 20K as a likely during a blow-off peak. All the trillions of USD that have been created and sent all over the world will be coming home to America. No one will be interested in holding cash or USD government bonds that will surely be monetized by the Fed as the only options to expunge the various muni, state, and Fed debts. Last one out is screwed, and that sentiment will be universal. I look at all of the debt along with the piles of car loans, student loan, mortgage paper, credit card debt, and so on as a giant money reservoir of potential inflation energy. The Fed will let some of that bond paper be wiped out, but will banks be monetized the majority? The big banks will be kept solvent. The system must continue on, and the only path forward is debt monetizing, especially government debts, and funding infrastructure spending with QE bond purchases. Hugely inflationary long term. Bit by bit, major global players will be dumping bonds they view as articles of confiscation, instruments of sure financial destruction that are guaranteed to underperform inflation. And interestingly, the more people bail and seek gold or other real assets as an alternative, the more the central banks will be forced to monetize, the more they will have to QE and be the buyer of last resort. The cycle will fuel itself and lead to skyward pricing in real assets. Third world commodity producers will be demanding rapidly increasing wages. All input costs cycle up as commodity prices all rise. Great uncertainty leads producers to not being willing to lock in long-term sales contracts at fixed prices. The desire to have contracts will let them pass on rising costs will lead to further inflation pressure. Consumers or raw materials will want to do what they can to lock in prices and have what stability certainty they can get. This will be done by over-contracting and stockpiling. Also, demanding increased prices for finished goods to protect margin. Again, inflationary. We've worked on developing an amazing global infrastructure over the last 100 years so that we can be as efficient as possible. Just-in-time inventory became the norm. We are now going to enter a period of stockpiling for security, certainty, along with hoarding for speculation. To conclude, in the subject of speculation, before this commodity resource cycle is over, the idea of owning stockpiling real assets won't be considered speculation, but it will be the norm. I've often argued that our financial system has been perverted and corrupted so much. The ultimate speculation now is foregoing consumption ownership of things you know you'll need in a few years and buying stocks or bonds instead. We all speculate that money in our banks or bonds or stocks will be better than trying to lock in prices on things we know we need. Wouldn't it be great for retired people, as an example, to be able to have the peace of mind from locking in the future price of all the energy, materials, and food they will need for the rest of their lives rather than have to gamble with investments? Dramatic changes are coming, and my bet is that precious metals will keep pace with other commodity prices with much greater, less speculative than a bond or general equities portfolio will, especially when you factor in volatility. So that's a huge thread on where he sees the price of gold going. I agree with it 100%. We know that gold's going much higher. We also know that gold is priced against other assets very cheaply right now, and that gold price has not accounted for the M2 money supply in the system. The market conditions are coming where all of this is going to get revalued. I agree. I also think that those things that have great utility to humankind, like silver and platinum, and some of these other ones where we are going to use it in the production of goods, will have gigantic upside because industry is going to panic at some point and they're all just going to pile in and hoard. They're going to hoard a bunch of materials to keep their productions going. Here's one. It says WTI popped due to OPEC news, but underlying commercial inventory fundamentals are supportive. 11 million total commercial petroleum stock drawdown this week. WTI fair value price is in line. Lowest commercial inventory reading since January 5th, 2023. So if we, if we look at overvalued is up on the top, undervalued is the bottom, we're actually fairly priced given where we are in the commercial inventory level. All of that SPR inventory that we soaked up last year was considered supply, not inventory. But looking at inventory levels of just the commercial, we are at fair value. Here's one that says, cheapest way to generate electricity leads to the highest electricity rates. I thought this was good, and this is all about renewables. Solar power is now the cheapest way of generating electricity, according to the Intergovernmental Panel on Climate Change, except wherever they use it has the highest electricity rates because it doesn't work. It's not reliable way to generate electricity because the weather has an impact on it generating electricity. Nice try, though. January and February saw inventory builds. That's seasonally normal, not oil demand dying. March inventories are nosediving. We're bullish on the oil balances, and data is coming in even more constructive than our forecast. So what we've got going on here is we've got a lot of people who watch, they count oil barrels in inventory. That's basically what they're doing. They're saying demand is there because they're watching the inventory get drawn down. Others believe that the demand will get hit because of financial problems. I'm in the camp that financial problems will come and it could impact oil and draw it down for a period of time. That will be your entry point because the demand, the physical demand is there sucking down barrels. Who's going to win in the short term? I don't know. I think everybody thinks they know, and I'll say the technicals to me look like we could see weakness in the oil price, but the fundamentals are still pretty solid. I think we're going to do both on different time frames. I think we could potentially get a drawdown in the short term based off of the technicals and the way that the financial oil derivatives and products are being traded. And then I think we're going to launch shortly thereafter towards the end of 2022. I like this guy, Jettison Fast. He says, so a perma bull is someone who believes his long-term thesis on oil will play out and doesn't get phased with short-term volatility. If my thesis changed with every little bump in the road, I no longer have a thesis. I'm just a reactionary fool. And that's basically what everyone is that's a retail investor. They are basically reactionary fools. The thesis, and I have a thesis as well, which is still intact for higher oil prices. In the short term, though, you can have volatility and we could get pulled down. So I do shift a little bit of funds and overweight things in the short term to rebalance a portfolio. I do that, and I show what I'm doing on the website. But I don't completely abandon the thesis. A thesis is an outlook on the markets that has been derived off of something, some data, some cycle, some whatever. And you're going to get shorter term cycles within a longer term secular cycle. And I don't think a lot of the people, what they're doing is they're mixing time frames up, and you can be bullish and bearish at the same time on an asset, just on different time frames. And what I do is I want to maintain a core position in oil on the long side, because I think that we have some major issues in supply demand balances coming up over the next few years. In the short term, though, we could see oil prices draw back down based off of the shorter term cycle of the credit cycle, and credit and liquidity drying up for a short period of time, yanking it down. Now, we could have already had that move, and maybe that move is done. Maybe it's not. The short term is the hardest to predict. It's also the one that's the most emotional in the markets. You're playing emotions, and emotions are the hardest to predict because they can change at any point, and it can change very quickly. The long term is a fundamental game. It's the fundamentals. It's the supply demand. And I don't think we've got the supply of oil. Flat out, bar none, we don't have it. We look 5 years out, it's not there. So that's the way that I think we both look at it. And I think he's also right in his opinions here. Now here it says, poor SPR never had a chance. We've got Biden here. He says, I'm going to drain the SPR to zero. Just watch me, Joe Biden. Here's North Star. He says, I'm sorry to keep pointing this out, but I think it might be quite important. I agree. Bank of America stock looks like garbage. We've got these long uptrend lines. You can also draw another one coming across. We squeezed up, broke down, squeezed up. It's a bearish rising wedge, and we've broken to the downside, and it looks like we could really start to take off to the downside. This here is the financial liquidity type problem that I'm talking about, which could draw down oil in the short term. This is what it looks like. It's from the banking sector. And you look at JP Morgan, you look at Bank of America, or Charles Schwab, Bank of America, US Bank. You can look at all these different banks. They all look like garbage, ready to drop. You can also look at the interest rates, and the interest rates are also dropping, which generally indicates fear in the market and something that could potentially be coming. This here is where I think the problem is at, and I think it could yank all of the commodities down in the short term. It is possible. And I'm waiting for that to happen so I can load up in some of these really highly leveraged commodities to the price of gold. You look at a gold to oil ratio, oil could be priced at 1 ounce gold to like 40 or 50 barrels of oil. That is an anomaly territory, especially with where we're at on the supply side of oil. It's going to be one heck of an entry point coming up, in my opinion. Here's more information. It says a big drop. The average 30-year fixed mortgage rate slides to 6.16%. Huge drop in 30-year fixed rate mortgages, which will be positive for the mortgage market. It says FCX CEO, copper is a scarce commodity, and when opportunities to grow in the copper business emerge, for whatever reason, I think you'll see companies moving to take advantage. Probably because copper is going to be scraping the bottom of the barrel here for inventory. These guys know it. They're going to start probably doing some hostile, takeover bids. I know Glencore was going after Teck Resources. And copper is going to be one spot, especially if they've got mines that are in production, that are already producing. I think those are the lowest risk, best opportunities in the markets right now. Some of these guys creating new projects, I don't know if they're ever going to get them off the ground. It seems like a lot of the other areas in the world just want to shut down projects. They don't want the mining residual effects from mining. We'll say the potential, whatever it is, environmental issues with mining. They don't want to deal with it. Ferg says the subprime crisis was packaging low quality assets together and pretending they were high quality. The energy crisis roots lie in building low energy return on investment energy sources and pretending they are high energy return on investment. The latter is far worse since you can't print your way out of the problem. And that's the energy problem that we are seeing and experiencing now. Here's the barrel counter. After a week of January, February, driven by weather-induced demand weakness and higher than normal refinery downturns, the Big Three deficit has meaningfully improved and now sits only 4 million barrels above the all-time low. We remain bullish. This is the inventory deficits coming on down. You can see we're drawn back down again, and this is our little increase in inventory that we've reversed back lower. So we're continuing to draw down inventory levels. He says, you need not believe in a higher oil price, though we do. To be bullish on energy stocks, believe only in the price that you already see on your screen, and the average company we estimate can pay a 16% dividend while keeping production flat. That's at current prices. Market Sniper, he says, make a macro oil to drop 35 to 40% call and watch how many folks come at you 3 days later and say oil is up. Come back in 3 to 4 months' time when demand is roaring. There is no need to cut. Also, gas and uranium don't continue to soften. So what he's saying is that there's a macro event that is coming that could potentially draw down oil. I believe him. I do think that the technical charts look a little bit weak, and I do think that the interest rates dropping confirms his view about a potential drop in oil in the short term. I also am incredibly bullish on oil in the medium to long term. And I do think that we're going to have one heck of an entry point coming up in 3 or 4 months time frame. I agree with Market Sniper. But that's what we've got for today, guys. We can end it there. And if you guys need any help with these markets, definitely check out the website. Subscribe to the channel here. Click the thumb up button if you guys like the content. And we'll catch you next time. This is Finding Value.